Alright, imagine this opening shot, calm music playing, charts slowly moving on screen, and I start speaking directly to the viewer. Everyone keeps asking the same question right now: why hasn't the stock market crashed yet? Inflation is still high, interest rates went up fast, wars are happening, debt is exploding, and people are struggling just to pay rent and groceries. So logically, the market should have already collapsed, right? But it hasn't, and that's not an accident. Today I'm going to break down what banks, institutions, and insiders don't openly talk about, and by the end of this video, you'll see the market very differently. First, let's get something straight. Markets don't crash just because the economy is weak. Markets crash when liquidity disappears, and right now, liquidity is still flowing. Even if it doesn't feel like it in your personal finances, big money still has access to cash, and that's the first reason the market is holding up. Banks and financial institutions operate on a completely different level than everyday investors. While retail investors worry about credit card bills and rent, banks borrow money at special rates. They have access to emergency facilities, and they are closely connected to central banks like the Federal Reserve. When things start to break, they don't panic the way retail investors do. They prepare, and then they get support. After every major crisis, from 2008 to the pandemic crash, central banks learned one key lesson: never let the system freeze, because once credit stops flowing, everything collapses fast. So now, whenever stress appears, new tools quietly come into play: special lending programs, backdoor liquidity injections, and balance sheet adjustments that most people never read about in mainstream news. This is why you keep hearing phrases like soft landing and resilient economy. Those aren't just optimistic opinions, they are narratives designed to maintain confidence, because confidence is everything in markets. If people believe the system is stable, they keep investing, spending, and holding assets, and that belief alone can delay or completely prevent a crash. Another major reason the market hasn't crashed yet is because big institutions are not positioned for a crash. Crashes usually happen when everyone is overleveraged on the same side of the trade. Right now, many large funds are hedged, diversified, and sitting on cash. They are not all in bullish, but they are also not betting aggressively against the market, which reduces the chance of a sudden violent collapse. Banks especially benefit from higher interest rates. This is something rarely explained clearly. When rates rise, banks earn more from loans compared to what they pay on deposits. This improves their margins. So while rate hikes hurt consumers, they can actually strengthen large financial institutions. That's why big banks like JP Morgan Chase and Goldman Sachs are not rooting for a crash. They are managing risk while continuing to profit from volatility. Now let's talk about inflation, because inflation is a hidden tax, and it plays a massive role in preventing a crash. When inflation is high, asset prices naturally rise over time. Stocks, real estate, commodities, all of them adjust upward just to keep pace with the declining value of money. This creates the illusion that markets are strong, even if real purchasing power is not improving. Governments also benefit from inflation, because it reduces the real value of debt, and when governments benefit, policies tend to support inflationary environments rather than sudden deflationary crashes. A market crash would destroy confidence, increase unemployment, and reduce tax revenue. So from a policy perspective, a slow grind higher or sideways market is far preferable. Another thing most people underestimate is how much money is sitting on the sidelines. After recent volatility, many investors moved into money market funds and short-term treasuries, earning decent yields. This money is not gone, it's waiting. Every small dip becomes an opportunity for that cash to flow back into stocks, which creates strong support levels and prevents deep sell-offs. Social media and 24-hour financial news also play a role. Fear is spread constantly, but so is reassurance. Every dip is framed as a buying opportunity. Every bad economic report is quickly countered with a positive interpretation. This constant narrative management keeps retail investors engaged instead of panicked, and panic is what causes crashes. Let's also talk about earnings, because despite all the negativity, many large companies are still profitable. They cut costs, laid off workers, automated processes, and raised prices. All of this protects earnings, and as long as earnings don't collapse across the board, the market has a foundation to stand on. Stock prices ultimately follow earnings, not headlines. Another uncomfortable truth is that the system is designed to protect itself. Banks, governments, and institutions are deeply interconnected. If one major piece falls, the entire structure is at risk. So interventions happen quietly, overnight, behind closed doors. You rarely hear about them unless something goes terribly wrong. By the time retail investors realize support is in place, the danger has already passed. Now, does this mean the market will never crash? Absolutely not. It means crashes are delayed, managed, and often engineered to happen when positioning favors institutions, not retail investors. Real crashes usually happen when people least expect them, after long periods of calm, not during times of constant fear. Right now, fear is everywhere: recession warnings, debt fears, geopolitical risks, and that widespread fear itself is acting as a stabilizer. Because people are cautious, leverage is lower than in past bubbles, and speculation is more controlled. Ironically, the constant talk of a crash is one of the reasons it hasn't happened yet. Another key point is demographics. Large institutional retirement funds need returns. Pensions, 401k plans, and sovereign funds cannot sit in cash forever. They are forced buyers of assets over time. This creates a constant underlying demand for stocks, especially large-cap companies, which keeps indexes supported even when smaller stocks struggle. Technology also plays a role. Algorithmic trading, volatility controls, and circuit breakers slow down panic selling. Markets today are structurally different than decades ago. Sharp crashes are harder to sustain because systems are designed to pause, rebalance, and stabilize price action automatically. But here's the part banks really don't want you to focus on. The market doesn't need to crash to cause pain. Sideways markets, inflation, and selective downturns can quietly drain wealth over years. While headlines claim everything is fine, this is far more effective than a dramatic crash, because people don't react until it's too late. So when you ask why the stock market hasn't crashed yet, the real answer is because it's not in the system's interest to let it crash, at least not right now. Liquidity still exists, confidence is being managed, institutions are protected, and inflation is doing the dirty work quietly in the background. The key takeaway for smart investors is not to wait for a dramatic crash that may never come, but to understand the environment we're in: volatility, inflation, and controlled risk. Positioning matters more than predictions, patience matters more than fear, and awareness matters more than hype. If you're watching this channel, Stock Predictor, you're already ahead of most people, because you're questioning the surface level narrative. Keep learning, keep adapting, and remember, markets don't move the way most people expect, they move the way power, liquidity, and incentives align. And the biggest secret of all is this: the market hasn't crashed yet because it doesn't need to. The system is still working exactly as designed, just not in favor of the average investor who doesn't understand the rules. If you found value in this breakdown, make sure you stay connected, because when the real shift comes, it won't be announced on the news, it will be felt quietly first, and by the time everyone else reacts, the opportunity will already be gone.